Hello everyone, my name is Dr. Anshul Sharma. I take the lecture of financial management for you. Today I will discuss capital structure theory for you. Now first of all, what is the meaning of capital structure? Capital structure means proportion of equity and debt used by an organization. For example, person want to start a business. It has rupees 50 lakh in bank account and the business which he wants to start requires rupees 1 crore in total. It means he has to go to the market to collect rupees 50 lakh. Now, when he goes to the market, he has different sources. It may be banks who are providing loan. It may be relatives who are giving financial assistance. It may be friends. It may be public. It may others. So, for example, a person who had rupees 50 lakh go to bank and collect rupees 50 lakh as a bank loan. Then, if we talk about the capital structure of the particular firm, now 50% equity and 50% debt. So, capital structure means the proportion of equity and debt in the total finance used by the organization. In today's session, we will cover these topics. Number one, concept of capital structure planning, concept of value of a firm, significance of overall cost, which is also called WACC, capital structure theories. In capital structure theory, we have four types of theories: net income approach, net operating income approach, Modigliani Miller, and traditional approach. Now, let's start again. Capital structure can be defined as the mix of on capital. It may be equity and borrowed funds, which I already discussed with you. It means if you are having rupees 50 lakh in your account and you are collecting rupees 50 lakh by way of different sources, it may be debenture, loan from bank, financial institution. These are the various sources. So in this condition, the proportion of equity and debt will be 50-50%. Maximization of shareholders' wealth is prime objective of a financial manager. The same may be achieved if an optimal capital structure is designed for the company. It means although we may get the funds by different sources, by different way, but if you are a financial manager, your task doesn't complete here. But actually you have to think beyond this. You have to plan the capital structure in this way so that the value of the firm may be maximized and the wealth of the shareholders may be maximized, because as you know very well, if you are a financial manager, it is the prime objective of financial manager that he has to maximize the wealth of the shareholders. So if you have 50 lakh rupees and simply you go to market and collect rupees 50 lakh, then you can't say your work completes here. But you have to design the capital structure. It means you have to plan the proportion of equity and debt sources in this way so that the value of the firm may be maximized. Planning a capital structure is a highly psychological, complex, and qualitative process. Qualitative process means because I have discussed earlier that whenever you have to plan the capital structure, your work doesn't complete with collection of debt, a collection of finance from the outside world, but you have to plan accordingly so that the value of the firm may be maximized. So it's not a very simple task, but you have to keep in mind so much things. For example, theory says if you are having more debt in capital structure, then the value of firm maximize. But on the same time, in practical life, if we see the what are the implications? Implications is normally when a company is taking more and more leverage from outside the world, then the consequence will be that the financial statement of the firm will be riskier. In that condition, the investors who are adhere with the organization will not keep themselves with the organization in a long run. They will go and join another organization. So, whenever you have this opportunity to plan the capital structure, you have to see in mind the value of the firm as well as the riskiness of the financial statement. If a firm is more riskier, then investor will not be ready to keep themselves with the organization. It involves balancing the shareholders' expectation and capital requirement of the firm. Same, which I have discussed, that you have to plan accordingly. You have to plan in this way so that we may take care of shareholders as well as creditors of the organization. Because if we are thinking only for the shareholder, although it's a prime objective for us, but we have to take care of our creditors as well, because when we require fund, they help us. So there is a relevance of creditors for any organization. You can't survive without the help of the creditors in current scenario. Now, planning. These are the points which we have to keep in mind. Number one, return. Ability to generate maximum return to the shareholders. It means EPS and market price should be higher. So whenever you have to plan the capital structure, you have to keep in mind that return of the organization should be increased. It means the stakeholder who have put their money in the organization have significant return, which should be comparable with other alternative. If they are getting handsome return, they will be with the organization in a long run, otherwise they will leave the organization. Number two, cost. Minimize the cost of capital, with debt is cheaper than equity due to tax shield on interest and no benefit on dividend. Number two is a cost. Whenever we have to plan capital structure, we have to think about the cost of the capital. And cost of capital means, for example, a firm had rupees 50 lakh and it had option to collect rupees 50 lakh from outside the world. And the finance manager of the organization went to a bank and banker gave the loan at 12%. The cost of capital of debt is 12%. If it has another option where the funds could be available at 10% or 8%, then he should try its best to get the funds at minimum possible cost so that we may decrease the cost of capital. And on the same time, as we know very well, if we are getting more fund by the way of debt financing, then because of tax shield, actual cost of debt is comparatively below. Then it is given as coupon. For example, suppose you are getting a loan from bank at 12% and tax rate is 5%, tax rate is 50%, then actually cost of the debt will be 12% into 1 minus 0.5. 0.5 means 50%. So cost of debt after tax will be only 6%. And as you know, whenever we have to take any decision in financial management, we have to take after tax. Whenever we have to talk about the costing, it should be after tax. And whenever we are talking about return, it should be after tax. So cost after tax of debt is around 6%, although when we got it, it was 12%. So it is preferable that if you have the stability in the operation and if you have stability in return, then you should go for debt financing, because when you are getting more funds as a debt, then cost of debt is always lower in comparison to equity. Equity is a costlier source and debt is a cheaper source. But at the same time, you have to maintain a trade-off. Number 3, risk. Risk means, as in last point we discussed, that although cost of debt is lower in comparison to cost of equity, but if we increase the proportion of debt in capital structure up beyond a level, then the risk increases beyond the level. So we have to keep in mind that risk should be calculated and risk within a range. If risk goes beyond the range, then it will be difficult for the investor to keep themselves in your organization. Now, next one is control. Avoid dilution of management control, hence debt preferred to new equity share. Next point is control. If you are running an organization and you want to have control over the operation of the organization, then it's preferable to collect the fund by the way of debt, because if you are collecting the fund by the way of equity, it means your stake is diluted. For example, earlier organization had distributed or you can say organization has floated 10 lakh equity shares in the market. Now after certain time it again floated 10 lakh equity shares. Now suppose you are a key stakeholder and you had around 5 lakh equity share when you had 5 lakh equity share, then your control was around 50%. Now, if you are floating again 10 lakh more share and you are not purchasing these shares are purchased by other group. Now, your stake will be 25%. If your stake is 25% in comparison to 50%, it means it's a dilution of control. And whenever you have dilution of control, it means whenever your control is diluted, it means you have to struggle whenever you have to take any decision for the organization. Because if you have control, then decision making is easier for you. But whenever your uh, ownership is limited, then your control will be limited. Flexible. Alternate capital structure without much cost and delay to raise funds whenever required. Flexible means the capital structure should be so flexible so that whenever you want to change the capital structure, you may. It means, suppose you have 90% debt financing and 10% equity financing, then you can't say this is a flexible capital structure. That's not a flexible capital structure. If you have 60, 40, 40, 60, 50, 50%, you can say this is a flexible capital structure. It means although take debt, take the advantage of the debt, but if you are using more and more debt, it may be problematic for the survival of the organization. So these are the points whenever you have to plan the capital structure, you have to keep in mind. Last one is capacity. Capacity means ability to generate profit to pay interest and principal. It means capacity of the firm should not be affected adversely. It means the amount of profit should be so much so that you may pay the creditors, you may pay the dividend to the stakeholders. If you are having more debt and very huge debt, then it may be a problem for you if you are not earning higher profit. So you can say if you are earning a profit of rupees 5 crore, then your liability should not exceed rupees 5 crore. Your liability should be around 50 or 60%, so that you may be able to keep around 40-50% with the organization, and this fund may be used whenever required by the organization. Now, value of a firm depend upon earning of a firm and its cost of capital. Earning are a function of investment decisions, operating efficiencies, and weighted average cost of capital is a function of its capital structure. This is the value of the firm. It means whenever we talk about the value of the firm, we have to keep in mind these are the assumptions. Value of firm is derived by capitalizing the earning by its cost of capital, WACC. If you are thinking that why we are talking about it, actually now we will discuss about the capital structure theories. there are different capital structure theory: net income approach, net operating income approach, Modigliani Miller approach, and traditional approach. Now, all these theories talks about the value of the firm. So, what is the value? Value means, for example, a firm has around 10 lakh shares outstanding in the market, and the market price of a share is rupees 500, then the wealth of the organization is 500 into 10 lakh. It is the wealth of the organization. You can say this is the market value of the organization. So these are the assumptions actually, and these are actually affect the organization's value. Number one, cost of capital. And what is the effect of cost of capital? I have discussed it. Now, value of a firm varies due to changes in the earning of a company or its cost of capital or both. So you can say, when we talk about the value, it means the share price of the organization is changing. It means there is a change in the value of the organization. For example, there is a firm, it had 10 lakh outstanding shares, and the market price of the share is 500, and after 1 year the market price of the share is around 600. Now, if we talk about the value, you can say it's a 20% increase in the value of the firm. Now, value of the firm has increased by 20%. Now, what are the reasons how value of the firm has increased, or you can say how the share price of firm increased? Normally, share price of the organization increases when investors think that the organization has better potential in the future. If organization has better potential towards the return, then price of shares increases. On the same time, as you know very well, profit is equal to revenue minus expenses. So, potential of organization increases because of two reasons. It may be because of revenue, and it may be because of cost. So, if organization is earning more revenue, then prospect of company has become good. And if company could reduce the cost of capital, then again company would be in the position to increase the profit, and ultimately it will affect the value of the firm. So ultimately we have to increase the profit of the organization. If we could able to increase the profit of the organization, simply we would be able to increase the value of the organization. So we will concentrate on these two things, cost and revenue. Let's see an illustration about the calculation of EPS. In last lecture, I have discussed when I taught you EBIT, EPS and cost of capital. I have discussed with leverage also that whenever you have to calculate EPS, what is the way? So this is the way. First of all, sales. After that, you have to deduct cost of goods sold. Then you get gross profit. From gross profit, you have to deduct operating profit, operating expenses, then you will get operating profit. It is also called EBIT. Next, you have to deduct interest. We also call it IATIT minus I interest. Now, the figure will be EBT minus tax. In the illustration, tax is at the rate of 30%. So I am charging at the rate of 30%. If it is given 40%, you may charge 40%, and if it is given 50%, you may charge tax at the rate of 50%. Now, if we deduct tax, then the figure which we receive is profit after tax minus preference dividend. Now, it is profit for equity shareholder. Now, write down the number of equity shares. If we divide profit for equity shareholder divide by number of equity shares, then we find earning per share. Now, let's discuss about capital structure theories. These are the assumptions which we have to keep in mind. Number one, firms use only debt and equity, no other source. It means firm will never use reserve and surplus. As you know, whenever we have to prove any theory, we have to make some assumption. So, in case of these capital structure theories, we have to assume that our organization where we are testing the model or we are testing the theory, then it should follow some terms and conditions. Condition number one, firm will use only equity and debt as a source of fund. It means reserve and surplus will not be used, retained earning will not be used as a source. Second thing, no change in investment decision of the firm. No change in total asset. During the testing of the theory, the investment pattern of the organization should not be changed. It means during the period, organization should not purchase any type of asset. It means the routine which was applied by the organization should be continued during that tenure. It should not be changed in any way. Number three, 100% dividend payout ratio. As we already discussed that no retained earning will be used if organization has. But it's clearly mentioned that during the tenure, no type of retained earning will be maintained by the organization. The amount of profit which is earned by the organization will be distributed to shareholders. It will not be kept by the organization as a retained earning. Business risk of a firm is not affected by the financing mix. Number four, business risk of the firm is not affected by the financing mix. It means if you are using more and more debt, normally it increases the risk. But as I have discussed earlier, that whenever we have to apply a theory, it has some assumption. So this theory has an assumption that if an organization uses more and more debt, then there is no effect on riskiness of a firm. There is no effect on the riskiness of a firm. No corporate or personal tax. Investor accept future profitability of the firm. Now, net income approach proposes that there is a definite relationship between capital structure and the value of the firm. It says there is a direct relationship between capital structure and the value of the firm. When we will discuss about NOI, it has some different perception. So now I'm talking about the NI. NI has the assumption that the capital structure and the value of the firm are having a relationship. The capital structure of a firm influences its cost of capital and thus directly affect the value of the firm. These are more assumption of NI. NI approach assume that a continuous increase in debt does not affect the risk perception of investors. Number two, cost of debt is less than cost of equity. Corporate income tax do not exist. So there are three assumptions which we have to follow in NI theory. Number one, that if you are using more and more debt for the organization, that there is no change in risk perception of the investor. Number one, that's a very important assumption. And number two, cost of debt is less than cost of equity. And number three, corporate income tax do not exist. Now it's very simple. He says if a firm uses more and more debt, it means the firm is using cheaper source of finance. For example, suppose there are two options, equity and debt, and if your assumption that the cost of debt is cheaper, suppose cost of debt is 6% and cost of equity is 10%, so it's definite that cost of debt is cheaper for the organization. Now second point is how much amount organization want to use as a source of finance. It depends on the organization because there is no effect on the risk perception, so it means around 90 to 95% of the funds may be collected by the debt. Now, if organization is using cheaper source, around 90 to 95%, and costlier source is used by the organization is only 5 to 10%, it means by using more and more debt, by using cheaper source, the organization will be able to decrease the cost of capital. And we know very well, if we could reduce the cost of capital, we could increase the amount of profit, because profit is equal to revenue minus expenses. Now, for example, if organization is having revenue of rupees 10 lakh and expense was rupees 8 lakh, then profit was 10 lakh minus 8 lakh is equal to 2 lakh. But in other condition, when organization has revenue of rupees 10 lakh and now organization could possible to reduce the cost up to rupees 5 lakh, then profit of the organization increases. So if profit increases, then value of the firm increases. Now take the example of NI approach. Higher use of debt capital will result in reduction of WACC. As a consequence, value of the firm increase. Same which I have discussed with you. EBIT being constant and WACC reduced, the value of the firm will always increase. Thus, as per NI approach, a firm will have maximum value at a point where WACC is minimum. So simply we were focusing on the weighted average cost of capital. If we could reduce weighted average cost of capital up to a certain level, then simply value of firm increases. Now this is a graphical representation. Here you are seeing cost of equity, here you are seeing cost of debt. So it says whenever you are increasing the proportion of debt, overall cost of capital reduces. Now let's take the help of an illustration to clear it. This is the illustration. Calculate the value of firm and WACC for the following capital structure. This is EBIT of a firm rupees 2 lakh, cost of equity 10%, KD 6%. Now you have to find out WACC for the following capital structure. Number one, when debt capital is rupees 5 lakh, when debt capital is rupees 7 lakh, when debt capital is rupees 2 lakh. This is a format which you have to follow. First of all, you have to write down EBIT minus interest, then you get EBT. After that, you have to find out value of equity and value of debt. If you see it carefully, then see this point. This is total value of a firm. Whenever you have to find out total value of the firm, you have to find out value of equity and value of debt. And value of equity means E, value of debt means D, value of firm is equal to V. After calculating value of equity and value of debt, you have to sum up both the value, then you will find out value of the firm. Now, what the method to calculate value of equity. Because value of debt is given to you, now you have to find out value of equity, nothing else. So the formula of value of equity is EBT divided by KE. EBT divided by KE. And to find out EBT, we have to follow this structure. EBIT minus interest, the resultant figure is EBT. Now, whenever we have to find out value of equity, simply you have to divide. It means in numerator you have to write down EBT and in denominator you have to write down KE. Then the resultant figure which you receive will be value of equity. Now let's do it case wise. Case number 1. EBIT is rupees 2 lakh. Because in the question we assume that the EBIT will be same and capital structure of the firm is different. So in first condition EBIT 2 lakh rupees, in second condition EBIT 2 lakh rupees, and in third condition EBIT 2 lakh rupees. Now minus interest, it is given that KD is equal to 6%. Now because debt is 5 lakh, so interest will be 6% of 5 lakh will be 30,000. If we deduct it, then we will get EBT. In second case, debt is 7 lakh and KD is 6%. It means cost of debt will be 6% of 7 lakh. It will be 42,000. If we deduct it, then EBT will be 158. In third case, when debt is rupees 2 lakh, here interest will be 6% of 2 lakh will be 12,000. If we deduct it, we got EBT as rupees 1,88,000. It means in these three conditions, EBT will be 170, 158 and 188. Now, KE is given 10%, so we write down KE 10% for all. Now, value of equity is EBT by KE. It means if 1,70,000 divided by 10%, then the value will be 17 lakh. If 158 by 10%, value will be 15 lakh 80,000. And if 1,88,000 divided by 10%, the value will be 18 lakh 80,000. It is the value of equity. Now, value of debt, it's 5 lakh, 7 lakh and 2 lakh. Now, you have to find out total value of the firm. V is equal to E plus D. So here we have E, 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 and here we have D, D, D. Simply you have to sum up both the values. Now, if we sum up both the values, then here we have 22 lakh, 17 lakh plus 5 lakh is equal to 22 lakh. In second condition, it is 15 lakh 80 plus 7 lakh. It will be 22 lakh 80,000. And in third condition, 18 lakh 80,000 plus 2 lakh, 20 lakh 80,000. So this is the value of the firm. And we have to check two things. Number one, value of the firm. If we talk about the net income approach, it says that number one, value of firm increases if a firm use more and more debt. And it's very much clear that when an organization had rupees 5 lakh debt, then the value of the firm was 22 lakh. But when organization increased the amount of debt to rupees 7 lakh, then the value of the firm increases by rupees 80,000. Now it was 22 lakh 80,000. And when it decided to reduce the amount of debt, the value of organization decreases. So this is a proof of net income approach. But second thing, it says that when we use more and more debt, then the cost of the organization increases, cost of the organization decreases. It's very much clear because you know if we are using more and more debt and debt is easier, debt is cheaper, then cost of the organization decreases. But we have to solve it. The formula is EBIT divided by value of the firm into 100. Now EBIT is 2 lakh divided by 22 lakh into 100, 9.09%, 8.77% and 9.62%. Now it is clear that when an organization increase the proportion of debt in second condition, then the value of the firm decreases up to a certain level. So this was the net income approach. So for today, I think it's sufficient for you because in next section we will discuss about the net operating income approach, Modigliani Miller approach and traditional approach. It was first session about the capital structure. In this session we have discussed about the capital structure, what is the meaning, what is the significance, how you have to plan, and whenever you have to plan the capital structure, what you have to keep in your mind. After that, we have discussed about 4 theories. We discussed in detail net income approach. And net income approach, it was the assumption of this theory that if you uses more and more debt, then the value of firm increases and the overall cost of the firm decreases. So by assumption, by giving some example, and after that some illustration, this topic now complete. Now we will meet with another topic. Thank you very much.